Hey guys, my name's Max. Welcome back to the channel. It's a beautiful Saturday in the fall. I have football on. The two teams I follow aren't playing today, so I thought I'd catch up on a little work. I did this interview the day before yesterday with the founder of a fund called XVOL, XVOL. I think you guys will be interested in it. Let me show you what I got. All right, here's the fund we're going to be talking about today. It's XVOL, the Acruence Active Hedge U.S. Equity ETF. Acruence is a wealth management company out of Dallas, and we're going to be speaking with the founder today, Rob Emrich III. It's a very interesting fund. You can see right now I compared it with Z-Hedge and TJUL, which are other funds that do similar things. You can see XVOL doesn't have that much money under management right now. Now, it used to have more under management. There's a story behind it. It's going to have more under management soon as well. Z-Hedge is a fund, a Jay Pestrichelli fund from Zega Financial that is similar. And then I've had content on TJUL before. So here's the year-to-date performance of all of them. I would just have you notice that XVOL is just a little bit, about just less than 1% behind the SPY, and Z-Hedge isn't too much further behind either of them. These funds are doing pretty well on the year, and the market's having a good year. Now, TJUL's only up 6.9%. They do a little bit different variation of the strategy where they take almost no risk. So, as you know, when you take no risk, you get no reward. And you can see TJUL's up less than half of what Z-Hedge is and about a third of what XVOL and the SPY are up. So I think XVOL and Z-Hedge have the right idea. But there could be a place for TJUL also. It all depends on your risk tolerances and goals. All right, so let's get into the middle of this conversation I had with them Thursday afternoon. Continue with what we were talking about as far as Drawbridge goes. Tell me Drawbridge's relationship in this whole thing, and we'll get to you in a little bit.
Well, Drawbridge, so I've been in the industry 30 plus years, and my passion has really been toward the portfolio management side of the business, and specifically the use of systematic rules-based strategies. And the reason for that is because systematic strategies remove human emotion, which, as you probably know, is a big detriment to a lot of investor returns anytime emotions get in the way. And also managing drawdown. Like, I think drawdown risk is probably one of the most crucial things to understand. And so I've kind of built a business around providing models and strategies that are, again, rules-based and characterized by very low drawdowns. And so basically how this relationship evolved was that, and I'll let Rob go into some in greater detail, but Rob contacted us, as he was exploring new suppliers or vendors for the underlying index to the fund. So,
but so you said XVOL was based on an index. I guess I didn't realize that. Could you tell me about the index it's based on? I wasn't aware of that.
So the underlying index is a strategy that really, in itself, is robust. I mean, if you look at the trailing 1 year performance on it, it's like 44% versus 33%. And I think year to date, it's about 27 versus 20, and I'm comparing to the SPY. So a logical question is, well, how does that happen? And what we've done is we've combined two separate strategies to where we own the top 25 stocks of each strategy. So the first strategy, is you correctly identified in your video covering XVOL, is that it is predominantly large cap and high quality large cap. And so the first thing we do is we exploit the yield factor. So we take the universe, which most people call dividend achievers, stocks which have had consecutive increase in dividends for 10 years or more. And that becomes our initial universe. We isolate those that have the highest yield, so the top 50% of that universe. And then we overlay a momentum factor that it's a little different than how momentum is normally calculated. Like, look at all the white papers that have been written on momentum. They historically have gone back with 6-month or 12-month look back. And that's always been kind of the standard in most of those papers. Well, the question is, like, how do we know that that's the best look back period to use for every security? We don't. I mean, we're just trying to fit a security in a box that we think fits, but it may or it may not. So the process being used is more advanced in that it's looking at what is the best period and identifies that. So every security could have its own unique period for identifying that momentum factor. So anyways, by doing it this way, there's a couple of things that happen. First of all, you're isolating the yield factor by your ranking on yield. And we know that's one of the proven factors in capturing return in the market. But we're also eliminating the value trap risk that's inherent to those kind of strategies when you overlay that with the momentum, because now you're isolating those companies that are actually showing some type of a price appreciation.
Sure.
The other half of the index, the other 25 stocks, is again large cap, but it's purely the momentum. So it's looking at those that are performing the best in that particular rebalance period, which we rebalance.
Like NVIDIA or AMD or whatever's the hot stock.
We certainly have owned those names in the past year for sure.
How often do you rebalance?
Quarterly.
Quarterly? Okay. Mm-hmm. So, and you were saying before it was based, before your business relationship, it was based on a different index. So what was the date that you guys took over at Drawbridge?
Maybe Rob, you can address what kind of the history was there. I mean, it was November 1 of last year, to answer your question directly.
Well, because I got the one bad comment I got. Somebody looked at something from 2022 and said their performance didn't look good in 2022 or whatever. And I made an excuse for you guys. I said it's because the VIX didn't blow up enough. It was kind of a grind down. A lot of funds did bad in 2022. But anyway, I was also thinking it was probably back when Rob was having when using the different index. So it was based on a different methodology probably as well, right?
Yeah, correct. So, so I mean, if you want, I can talk about how XVOL was born and how it evolved. If that would be helpful, Max, you tell me.
Yeah, absolutely.
Yeah, so we had, we were run, I started Acruence Capital in 2018. I've been in business for 25 years. Started out as an advisor at Morgan Stanley, started trading options in 1997. And my expertise is really as a generalist overall in investments, but more specifically, my expertise is in indexes and options on indexes. And we had a program called a volatility capture program that in 2020, during the COVID crisis, did very well. We had, I believe it was February 7th, February 15th, we bought 17 strikes in the VIX. This is going back to 2020. VIX, of course, back in 2020 peaked out at 82.69, and we settled at 69.76. We grabbed about 52 points in the VIX.
Yeah, that was a good feeling, I bet.
Yeah, it was great. It was great. All in all, it was about a 3,700% return, and we had some publications give us some call it limelight for that. We got some attention.
Yeah, I saw something on that. I read that last night. That was awesome.
Oh yeah, so it was good. So part of our business is we have an OCIO business. So we help RIAs with trading. We help them build models, IPS statements, help them match client risk to models. Okay. And we've got about a 5-year track record on our models that I think is very good. Well, this particular RIA was interested in bringing us in to take over their OCIO function. And one of the things that came up was, hey, we like this option program, but we have 1,800 clients, all at Fidelity. We don't want to do, 3,000 pages of paperwork. So why don't we start an ETF where we'll use the S&P 500 as the base and the base holdings, and then your firm will overlay the volatility capture program.
Okay.
So that's what we did. So we did that, and we put the client's money in there. And at one time, if you look back, we had 115 million in XVOL.
Okay.
Well, everything was going well, and the firm ended up being sold to a large aggregator of RIAs, and we had a good relationship with them. They signed a contract with them. We did OCI work for them, but they just said, "Hey, we're not an ETF business. We don't want our clients in an ETF that we run or we own. So we don't want that conflict, so to speak." So the assets left. And that's why you saw it dropped about 30 million, and now it's sitting around 7 million. Well, the one thing that we've always said was with volatility, if volatility spikes and it happens fast, that's good. That helps us. If it's a slow grind down, like think before 2022, I would have said think of 2000 to 2002, right?
Sure.
The S&P kind of trickled down, but volatility, if you measure by the VIX, stayed in the 20, 30, 40 range. Okay.
Sure.
For a 2-year time period. So volatility, you didn't get that volatility pop. So in 2022, that was the worst of all worlds. Grinding down. We're spending money on premium on the VIX that ended up adding to the negativity of the fund just a little bit, but we were in line with the S&P 500. So it was at the end of 2022 where I met with my investment committee, and I'm very blessed to have some very, very smart people around me. Some of the, I think, arguably some of the best quants in the world, or at least some of the best data scientists in the world I have around me. We could talk about that later if you want. But we decided that we needed something that could protect on the downside better than a volatility option or volatility options that require a large spike to dampen volatility.
Sure.
So back in my day, I worked for a firm called Alliance Bernstein. And one of the things Alliance Bernstein did a lot of work on was, of course, Alliance Bernstein was formed from a growth firm and a value firm. Yeah. So I saw the benefit of blending growth and, for lack of a better term, value. Value in this case would be dividend stocks.
Sure, of course.
So I started to shop around and say, because we don't have that expertise. So I started to shop around and look for a potential partner. And we found a partner, but the challenge I had with them, and if you look at our returns in 2023, we're up 7.42%. They were too heavy in cash, and I didn't want that. I wanted something to be fully invested. So I'm always looking for something that is robust and can last long term. Don't want to jump in and out of strategies, however, but I did not like how much cash was being held.
Sure.
So, at the time I agreed with it because I committed to that. So we stuck with it. Had there been now we own some put spreads in there in addition to the VIX. And let me tell you, if the market had gone down very rapidly in 2022, we would have been rock stars, right? We would have looked great.
Sure.
As it was, market went straight up. So I started to look around for a money manager that could manage the equity portion with value and growth, 50-50 split. And that's where I was introduced to Tim. Actually, the title team introduced me to Tim. They had a relationship with him. And we looked at some of the live testing they had. They had run their index for about a year, and then looked at their back testing, make sure their back testing was done properly, because in this industry, a lot of back testing is not done. I would say 90% of back testing, maybe 95%. Some of my colleagues will say 99%, but some of the back testing isn't done well. They actually did a great job with back testing because their back testing actually matched the live dollar traded returns, which was good.
Yeah, that's important.
So that's why. So after we did all our due diligence, it was in November of 2023. November 1, we went live with these guys. They provide us the research. We do all the trading. They provide us the signals, and we do all the trading to run what we call their underlying actively managed index.
Okay. So let me ask you this. Is that index published anywhere that could anyone, if I had an ETF, could I make it based on the same index, or is it bespoke index for you, custom?
Yeah, we have an exclusive agreement to run that index. So, awesome. Obviously if somebody wants to run it in an SMA, they'll go through us, so we could allow that. But we have exclusivity to that index.
Okay. No, that's awesome. Well, let me ask you this real quick. Tell me a little bit about your vol capture program. So you mentioned, I heard you mentioned that in 2020 you were long puts, or no, I'm sorry, long calls in the VIX, which is a great time to be long calls as it went to 85, or like you say. But I would assume part of the program, especially when it has the word capture in it, you're going to be selling some volatility somewhere, right? Am I right or am I wrong?
Yeah, you're right. Back then, so we've changed the program a little bit. So back then, it originally, so if you Google Lightening Spread hedge, I had trademarked that all the way back in 2015. And that was the very first iteration of our volatility program. It involves selling credit spreads with a maximum loss of about 1%, and using that money every 30 days to finance an out of the money hedge. So for example, we would sell, say VOL was around, measured by VIX, say the VIX was at 12-13, we'd sell a VIX spread from, say 20 to 25, and we'd sell it to raise about 1% dollars, and then, or not 1% dollars, 1% risk. And then we use that to put towards the premium to offset the cost of the premium, to offset the cost of that carry, the negative carry that's normally associated with carrying a hedge.
Okay.
So then that morphed into what we call the volatility capture program, which then morphed into what we're carrying in XVOL, which is more of a tail risk hedge. But if volatility spikes up, we do have the ability to buy puts. We do have the ability to sell spreads. We do have the ability to capture some of that gain. But because of some of the recent performance issues, we've kind of scaled it down a little bit. So let's get the equity portion running as we're running just right now, more of a tail risk type strategy inside of XVOL.
Well, and I'm fascinated with the equity portion too, and that's what's doing the real heavy lifting. But I'm kind of an option nerd, so I have all these option nerd questions. I probably ought to get you each on separately sometime or whatever. But anyway, no, I like this. Let me ask you this. What is OCIO or something you keep saying?
Oh, sorry. So that's just an outsourced chief investment officer.
Okay. Of course. I should have thought
that.
Yeah,
no. I should have said, a lot of people don't know that terminology. Yeah. They know CIO. You throw an O in there.
Yeah.
Correct. So we do. So as I mentioned, what that means is we'll come in and we'll handle for an RIA, everything for them. Trading. I think for this one group, we were doing about 1,800 trades a week. For some of those clients at one point. So it's a lot of heavy lifting, but a lot of RIAs don't take advantage of, or they're little, I don't want to say lackadaisical, but if I had to criticize some RIAs, it's that I don't think some of them do the trading well, meaning they have a big order. I mean, these are some big firms too. I've seen some bigger firms, they just send the order to the high touch desk at Fidelity. That's it. And Fidelity has about 5 liquidity providers. We have our own liquidity providers that we use. We have like GTS, Wallet, Beth. So there have been cases where we stepped away from Fidelity. We don't do it often, but there have been cases where we stepped away from Fidelity and have saved clients money, and that savings goes right to the client. So there's some of the services we offer.
No, that's great to know. Okay, I've been trying to figure out what OCIO meant. Okay. So you were mentioning quants and data science and stuff, and let me ask you this: is this program algorithmic or is it rules based? And I guess I'm talking about the VIX hedge right now.
Yeah, that's more rules based.
That's rules based. Okay,
correct.
Do you use machine learning or do you use I'm just wondering. I just wondered.
Yeah, so for me, I don't, but on Tim's side of his team we have a firm called Phase Tech or Phase Invest that we use. They do incorporate some AI models, some proprietary models that they have that incorporated and learn from the new data. Instead of having just a fixed data set, you actually have a fixed data set that's growing and being modified in real time. Tim could probably talk about that a little more. But,
yeah. So is that the phase detection engine? I saw something in the prospectus. Is that what that is? Well, tell me a little bit more about that, or tell us a little bit more about that, if you don't mind.
Well, that is, again, going back, looking at how a security behaves. And so if you think about a security, over its lifespan, it can have periods of consolidation. It can have periods of trending. various levels of volatility and so on. And so each of those periods or phases, we refer to them, you might well almost think of them as separate securities because they're behaving characteristically different in each period. So part of that phase detection engine, as we call it, is the identification of what phase that security is in. And obviously, when we put these and rank them into the index, we're identifying those that are in, a positive phase. And then the index is weighted. A couple of things I will point out again on the index, what I think is useful to know. We're maintaining pace with the S&P 500, but we're not using market cap weighting. And I think that's really, really important in today's environment, because when you've got the 10 stocks accounting for 30+% of the S&P performance, you've got a lot of concentration risk. And when we build these indexes, we use more of a smart beta type of ranking system, to where we're weighting either toward that yield factor or we're weighting toward that momentum factor. But in any case, the top stock is never more than 5%. And so you're getting this return, but yet the underlying return stream is very diversified. It's not concentrated as in a market cap weighted index like the S&P. And I think for investors in today's climate, I think that's really, really important to understand.
Yeah, I do too. And I've always been the kind of person that thought that technical analysis by itself doesn't, can be too subjective or something, but used, like as a momentum overlay, like you guys do, in conjunction with something else, maybe even with your own personal opinion or so. I love that. I love using different methodologies, together. And obviously you do too. Do you, and this is about XVOL, but just real quick, do you do this for, how many other clients do you work for besides these guys at Acruence?
Oh, I've been building out the, my own OCIO business, and since around 2000, I've been doing the model business started way back in 2000 when I was a CIO in a family office in St. Louis. That was, years ago now. And I just kind of kept building on to, extending the reach of the model business, making it available more widely. Okay. And that, it was originally offered to individual investors, and then it kind of morphed into realizing that a good half of my business was coming from other advisors who were like using these models in their practice. So that then kind of morphed into its own little channel of business. And, today we have, literally clients all over the United States that are offices that use, some of my model strategies to run their practices with.
So you guys have probably known each other a few years. Just being in the same business, I would guess. Or that's awesome. That's awesome. So tell me about, do you guys, and I'm thanking Rob on this one, do you employ quants or data scientists?
Yeah, so one of my partners is probably one of the pioneers of data science, John Elder. And,
I know. Yeah, of course.
Yeah, so John Elder of Elder Research. I've got a cool story if you have time to tell you about something that they've done. But yeah, he is he's the adjunct professor at University of Virginia. One of the stories I tell about him was, and you could Google this if you may know this, but in 2006, Reed Hastings of Netflix noticed that their attrition rate was a little higher than they wanted. And what they figured out was that when people log into Netflix, of course, it was more DVD driven back then. They log into Netflix, they spend some time, they look at, what the recommendations were. And if a certain amount of time went by, they would just log out and they could potentially lose that customer.
Okay.
So he determined that with his team, that if they could improve their recommendation engine by just 10%, it would improve their profits like exponentially. The attrition rate would drop and people would retain their services. So they had what's called the next Netflix contest. You could Google this. It's on Wikipedia. And Bloomberg did an article about it. They offered $1 million to any quant team that could improve their recommendation engine by 10%. Now, the data that they supplied, they had 100 million pieces of data, all anonymized, 480,000 users involving 17,000 movies, 20,000 teams from 150 countries. That's 20,000 people competed in this contest that lasted 3 years. Okay. So the winner of that contest ended up submitting their winning algorithm 20 minutes before the guys who came in second. And the guys who came in second were my partner, John Elder, and two of his partners. One of them you may or may not know, Jaffrey Woodward, who runs a $4 billion hedge fund in Virginia, QIM, very successful. And the other hedge fund titan is a guy named David Volatility, who runs Volatility Hedge Fund down in Florida. So John Elder research on ensembles ended up being what really allowed them to achieve this. So out of 20,000 people, they came in second, but they missed first place by 20 minutes. So just to say that I have access to some of the smartest people is not an exaggeration.
Yes, and I'm sure that goes for you as well, Tim, right? Do you have data scientists working for you, or?
I have relied more on outsourcing various. I mean, there's a lot of stuff, as you probably well know. I mean, I've scoured dozens, if not hundreds, of white papers on various topics. And so what I've tried to do is, like, there's some of that information which is practical, and then some of it's not that practical in terms of implementation in the real world. And so I've kind of made a business out of, like, figuring out what can be applied more easily. So a lot of it's been just my own digging through research and testing, lots of testing, and now 2 decades worth of real-time, real market results. So
sure, yeah, it's great to have of course, I know you guys know this, but to have a concept and back test it and it works, and then you do it over the next 6 months. I've done this before. Then you trade the strategy, and then it works in real life, similar to how it works in the back test. Then you think you have a good thing going. So let me ask you this: so how do you back test? Do you, and I can ask you, says, do you guys have somebody that writes the back test in Python or something, or do you use commercially available back test engines?
I've used both myself. I had a team in San Francisco that did some of my early testing, and this was when data was less available as it is today. I mean,
sure.
The quantum leap in just availability of engines to run this stuff on has improved dramatically in the time I've been in the business, and so it gets easier every day, I think. So I think that in the early days, it was literally building out, and of course too, there was less, like in the case of ETFs, some of the early models were limited by what was available. I mean, back in those days, you had Barclays and PowerShares and a few other companies to work with. I mean, today there's far more number of providers, and you can touch every asset class in every direction. So I think for investors, never been a greater time to be alive. You can touch every asset class. You can build these portfolios that are very sophisticated. And today at commission cost was zero. I mean, when I started the business, ticket costs. I mean, just the minimum cost to a client was either $40 or $100 just to do a trade. And the technology today is just superb. So.
Yeah, just think about those guys that brought Thinkorswim out, and that taught option trading to the masses. Mm-hmm. And for a long time, people had been able to get TradeStation, and you've been able to buy expensive stuff that was a little better, but still not nearly as good as the people in Chicago had. You're always getting your brains beat out by the market maker until Thinkorswim came along. I just think I think everything since Thinkorswim, and then other stuff that's happened, like the free commissions. Also, what about the 0-day options and all the freaking liquidity and how tight the bid-ask spreads were? Then around 2020, I kind of got back interested in options, and that was about the time the 0DTs came out. Not too soon after that, Yeah, and I think it's the golden age for anything retail, but especially for the option trader. And that's kind of my channel is kind of an option nerd channel. But we're looking in depth at the strategies. And so that's why I want to talk. I want to talk more about this, more about your VIX hedge thing. I mean, I have all kinds of, I like to really get into the details and know what tenor it is and what strike it is and stuff. But also at some point I realized that's not as interesting to the audience watching. Let me ask you this, Tim. Okay, so with all your research you've done and all the white papers you've read, and you guys can both answer this, I should say. Yeah, but what ETF is out there that is not out there yet that somebody needs to bring out? Is there a strategy that you know of, and that you think that somebody should bring an ETF out and you think it might help? Guys like me would like it, and maybe, I don't know. I would like it, of course. I like anything I'm fascinated with the SVOL strategy. I've heard about that for years. I've heard for years how hedge funds can monetize the roll yield, but of course that's something not at all accessible to a retail guy. And now you can buy SVOL. Yeah.
The challenge with SVOL is that they have, and other managers have this, is education. Because you have this, I think it's a very good product, but it has a high distribution rate. So these investors pull it up on a chart and they see it going down because they're looking at the NAV. They're not looking at the total return. They don't have their chart settings set to total return.
I know.
So there's a little bit of education involved with these things. Say, hey, look, you've got your NAV went from 20 to 1250, but you got 3 times as many shares now.
Yeah.
So it's a little bit of education with that still. It's great to see, and I like it. And there still needs to be some education and some updates to some charting software to accommodate that.
Very true. But there's guys like Jay, Pestruccelli and Sylvia. That's pretty much all they do is educate. Yeah. They're basically now they're in the education business. I mean, I'm being kind of cynical, but no, and they're good at it too. So what ETF is out? Is there an ETF, a strategy out there that hasn't come out? Because I have one in my mind. I'm going to try to pitch to you guys, but I want to give you guys a chance first. Is there a strategy out there that you maybe wish someone would come out with?
I would like to first go back to XVOL just for a quick second. And one of the reasons I'm so excited about being involved in this product is that, if you look at a lot of the hedge products out there, that hedge is costing a lot to the performance. I mean, and I kind of think of it like a boat anchor to performance. Like, it's great you got this protection, but at what cost? And then if you go back and look at, some of the decline periods, the funds are still down several percentage points. And I'm like, okay, so we just spent a lot of return hedging, but we really didn't get the benefit. And then if you go look at what we've been able to do now, we've got this new index in here, and we've maintained pace with the S&P 500. We haven't really given up much ground to our benchmark, but you don't even know the hedge is there. It's there, and we demonstrated that in August when we were up 12% the day the VIX went to 60. So I think having a product where the hedge is available to you when you need it, but it's not dragging performance down when you don't, is, I think, something that the market has needed, because it kind of there's some limitations of the ones that write at the money puts or that have the buffers and so on. I'm not saying they're a bad product. It just is a different approach. And so the fact that XVOL can provide the hedge but without an expensive cost, I think, is really helpful. And then when you combine that with yield, and you combine that with our abilities to write options to produce additional yield, I think that creates a really unique product in that market space that has not yet existed. My own thoughts would be, and this is something I've worked on over the years to try to get to market, would be something that is kind of almost like a hedge fund in a wrapper, really. It would be multi-asset class. I think of diversification in terms of process, like how do we blend different processes? Because there's not a single strategy that doesn't have some limitation, right? There's no perfect strategy. It doesn't exist. But you can get a smoother equity curve when you blend different styles or different processes. And so you can diversify away some of the process risk inherent to limiting to one style of process. And because, I mean, if we think about the traditional asset classes, they all kind of behave somewhat similarly. And if there's a, world event or something, they all kind of sway in the same direction.
Yeah.
And so, there was a paper from a hedge fund manager out of Austin, the Century portfolio, or the Serpent and the Dragon, I think is how
I love that guy. That's the best paper ever.
I agree. I've shared that paper many, many times. But that demonstrates how very distinct regimes drive distinctive performance in how within certain asset classes, and how in different regimes, there's always a better asset class. So if you have something that you could create that delivers with one click of a mouse, I can own the strategy that's going to provide consistent returns come almost anything. I think it's a winner. I mean, there are some good multi-asset class funds out there. I like Standpoint. I think they do. Eric does a really fine job with that fund. But because it's got some trend following commodities and other things in it as well, but something that does kind of incorporate those elements of that white paper that we're referring to.
So, okay, it's funny you should mention that, because the ETF I was going to pitch was an active long vol ETF, which is what we need to finish that. The white paper, it calls for 20% active long volatility, and there's no such thing. You can't, UVXY bleeds too much. But true. I don't know why somebody hasn't done a fund where maybe they own a out of the money strangle, but they finance it by selling daily or weekly straddles against it every day, selling this but using it, the old straddle strangle swap. But anyway, I wish somebody would come out with a fund like that. And it'd be such a niche, and that's probably why only people like me or somebody that's read that white paper would want it. But I'm fascinated with that type of strategy. In my own trading, I do straddle strangle swaps, diagonals, and ratio diagonals all the time, and it is, to me, the most powerful trade going. Like I say, I like to talk about option trades. And I should have said, absolutely, this XVOL is the fund that's not out yet, that needs to be out. I mean, it's been out for several years, but it's new. But I would say this fund is close to like a hedge fund in a wrapper, and this is my thought of what a hedge fund is. I'm just a small retail guy, that was a broker like 30 years ago for 5 years. So what do I know? But I like the element. I think because of the elements of the momentum elements and the income elements that you guys are working in, this could be a fund, XVOL, that should be able to take you through different phases of the market, should it not?
Absolutely.
Yeah,
okay.
No, absolutely. If you think about it, it has 4 strategies embedded in one ticker symbol, because you have the dividend growth stocks, momentum stocks, and then we have a put spread, a put selling program that turns on and off, and a call writing program, and then tail risk. So it's like 5 strategies built in there. And your point about long vol, why I like the VIX is if you get a pop, you can get so much convexity out of that.
Sure.
What we just saw on August 5th, of course, that was ended up being the biggest pullback. We had a 20-point pullback in one day. Where we hit, the difference between the high and close was greater than 20 points. It's only happened one other time in the history of the VIX, and that was on July 25th, 2005. You would think in 2008, something like that, right? But volatility was pretty sticky. So on July 25th, 2005, the VIX went up to 36 and closed at 11. So there were 2 goofy days, August 5th and July 25th. But, another piece of data, another data point I look at is if you go on the CBOE's website and, for my back testing, I buy a lot of data from the CBOE data shop. So I know that pretty well. But always wanted to know, well, how would the VIX have behaved in 1987? When you have this severe crash. Sure. And it's not perfect, but if you use OEX options as the CBOE has done, they go back, and I have the data in front of me. The day of Black Monday, October 19th, the VIX again, it's different than it is now. It would have been OEX options with the S&P 500. Would have hit 152.
I heard 125 once, but okay, 152.
Yeah. So I can see the data I have. So 152. The next day, it would have hit 172.
Okay.
So if you think about that, you look at all this fifth. We had a $7 million portfolio. I had 2,300 40 strike VIX options in there. So that means each point above $40, 40 strike, each point above would have added almost $250,000. So that means if we would have seen a VIX of 80 and expired there because they're European style, if I would have grabbed 40 points out of the VIX, the AUM would have doubled, would have been up 100%. It would have been 100%. So that's powerful. That's a powerful hedge. And then Max, just one more point.
Yeah.
What people don't think about is when you create a tail hedge, okay, the goal of a tail hedge is to create cash when it's needed most. If I hand you $1 at the top of the market, you're gonna be like, what am I going to do with this, right? But if I give you $1 at the bottom of the market, or when it's collapsed 10, 15, 20%, that dollar is way more valuable. So what we try to do is create that dry powder and then reinvest it back into the securities when they're depressed, so you get the compounded returns benefit, which is very powerful. Part of my reason for wanting to start the ETF was the advisors we were running our SMA for. When the VIX went from 70, we cashed out at 69, we had all this cash. The advisors I was running the money for said, let's not reinvest. I'm like, what? You've got to reinvest. They wouldn't let me reinvest the money. Had we reinvested, I mean, that cost them, I want to say that probably cost them about their clients 10 to 15% in return.
They shouldn't have done this. They shouldn't have done the spread. They should have put on the strategy if they weren't planning on reinvesting, because they took the risk. They exposed themselves to the risk, and Well,
I'll never forget the day they told me no was I'll never forget it, because I had the TV on in the background, and it was midst of COVID, and the story that came across as they were calling me, telling me we're not reinvesting the money, was hospital ships are going into the New York hospital for all the New York Harbor for all the patients. And so, I had a rules-based system to reinvest. They blocked it. At least now we're in an ETF where I can tell you within 24 hours that money is going to be reinvested, assuming we can, everything's functioning. But the next big spike we get, we will reinvest that money in its entirety in the portfolio and capitalize longer term, or at least attempt to capitalize longer term when everything comes back.
So, okay. So you guys are running two different things. We got Tim's stocks, and then we got Rob's option overlays. But is there for any reason that you would go to cash on either of them, on the stocks, or is there something that could happen and you guys would just go to cash?
No. Okay. I mean, I could make it delta neutral.
Well,
effectively the same thing, but
I know it's still. Yeah, would you do that? Is like if something like that.
It would be extreme. I can't imagine a scenario where I had to, but if there were some scenario, I could take the port. I guess I could imagine a few scenarios like that. Yeah. But not cash. But I could make it delta neutral. In
an emergency, you have that.
Right, some crazy. I mean, I don't want to sit here and speculate what that would be, but it would be total collapse and.
Yeah, I know it.
Yeah, so
you don't even want to speculate on that kind of stuff. But I think I know where you're going with that. So here's the other thing that I think people miss about tail hedging, either of you guys can answer this, but you have the VIX spike and it's important to catch it. But isn't another huge way that people should profit off it is when it's coming down the other side? When VIX spikes in there, I mean, don't you have to get in there and aggressively sell? I mean,
so we've done a lot of modeling on this, and the answer is undetermined. Meaning there's no correct answer, but we're most correct statistically by letting the option expire in the money. Okay, just letting it expire. For example, 2020, if we had sold it, right? There's not a whole lot of data. You could use some sophisticated target shuffling and create economic scenarios that don't exist, and then run thousands of iterations of that and test that. and it always comes out you're a little ahead if you let it expire. Now, that being said, what we do have at our disposal is I can lock in those gains. And the way we do that would be by buying puts. Now, the challenge with that, it's not perfect. There's a couple things we could do here. But in a nutshell, a normal at-the-money put 30 days out of the VIX, let's just say it runs $4, okay, sure, on average, okay?
Yeah.
During the spike of August 5th, at-the-money puts 2 weeks out, that's where expiration would have been, you were running $18.
Sure.
$12 and $18. So, and then you look at your expected return, even though it's collapsing.
It's not there. I mean, they've already priced it in.
So I'm not going to spend 18 to try to make 4 or 5.
Sure.
So it's very difficult. And then you get into a scenario where on August 5th, I couldn't get a bid on 40 strikes if I wanted to. We had 0 bid for the first 25 minutes of the opening session. Now, I saw strikes around me. It's just the way that the market maker was filling them in.
Yeah.
But when we started to see those bid asks, they were really wide, and there wasn't a lot of depth there. And the market's moving so fast, it's hard to, you could hit a liquidity provider and if they're going to pick up, right? Because they don't want to put bids out. So you end up with a mark that's a midpoint between two extremes, an extreme offer and an extreme bid. And the reality is, in hindsight, had you had sold some, you couldn't have locked in that gain that way. You would have probably lost 20% just on the bid offer. So pretty well. I don't have those prints in front of me, but I could pull them out another time or send them to you. But we made money off selling put spreads at the bottom and did lock in some gain that way too.
That's all I was trying to say. No, I know that your VIX hedge. Yeah, that's long vol. That's something separate. I switched courses. I switched past. I'm a big believer in selling volatility. I think it's something you ought to do every day if you can, just like going for a walk with the dog. I mean, that's what I was saying. Just from a systematic, I was talking more about the systematic selling of volatility. Well, let me ask you.
And I love Max. By the way, I love how you're thinking. That's exactly how we think. Yeah, what I was referring to was just specific to that VIX program, but outside of that, yes, absolutely. Historically speaking, in large spikes and even medium spikes, I am a big proponent. We have a vol selling program. We are very aggressive at selling vol. So we do a lot of vol selling.
Now, I'm imagining if I have a hedge fund, Max's hedge fund, I'd have a trader running long volatility, and they'd be in there buying VIX and doing that kind of stuff. But then I would be running a separate strategy, maybe where I had a guy over here, maybe in the 6-month time frame, selling volatility every day, selling straddles or that's all I was saying. Separate strategies. And that's all.
And I will say this: whenever we sell volatility, so I was born, I traded futures. So I had a futures program I ran for years. I was successful at that. And one of the things you learn as being a trader, so I'm trader born, is, back in the day, I blew myself up. If you're a trader, you're going to blow yourself up. And one thing I learned is I will never blow up a client. It's not going to happen on my watch. It's happened to me. It's a horrible feeling. A long time ago, every trader has a blow up story. So when I'm selling volatility, my risk is always kept. I know my risk to the penny. And part of my pitch is we talk to clients, we say, look, this is my risk. We will not lose 1 penny more than whatever it is, X, Y, Z. If we do you know what you do? And they look at me, I say, you fire us. If we violate these principles, you fire us. And they're like, you're the first manager that told us when to fire you. I said, you should fire anyone that can't manage risk. So we pride ourselves with managing risk on the downside.
Do you use the Kelly criterion, or what do you use? What method do you use? Fixed percentage?
No. So for us, so we're on retail side. Retail clients, a lot of it's fixed percent.
Okay.
So clients want to know, hey, I'm going to give you 10 million, Rob. What's my max loss on this program? I want it to be 10%. So
whatever.
Correct. Yeah, we're not doubling down.
I'm talking per trade. How do you size your trades? Do you do like a half point per trade? I mean, when you're sizing trades, how much risk do you take on each trade?
It'll depend on the program, but everything is laid out for us in our IPS agreement with the client. So, for example, we have a put selling program. I'm allowed to take 15% per risk per month. So I will take every bit of 15%. It's just how I spread that risk around.
Okay. No, I understand. One of you, and I'm sorry, I've been communicating with both of you guys over email, but one of you sent me an article, but it was about a put selling program where you have a customer that has 10 million. And so they have, 6 million in SPY or whatever growth, and then 4 million, and you sell puts for them. And I like how you guys in the article, you showed how to do a put spread and you cap the loss. There's funds out there that sell puts right now. And the only problem with them, they're great funds, but they have a down day, a 5% down day, 3% down day hits the NAV pretty hard. And I've always wondered why those funds didn't sell put spreads. And I know the answer, but I still wonder why they didn't. Anyway, let me ask you, had you ever thought about bringing a put spread fund to the market?
Yeah, I've in talks with a couple firms that have mentioned that. And just by the way, the guys, I'm not talking about anybody now, but the guys that sold volatility, sold put spreads, did not sell put spreads and blew themselves up, at firms like UBS and Wells Fargo. I mean, they have ruined it for guys like us because we can't even get in those firms. They won't even talk to you. Oh, we just do covered calls now. So I have a lot of resent for predecessors in the past that couldn't control their risk and lost, millions of dollars needlessly. I mean, why not cap your loss? I mean, so I make $2. I make $2 on the credit. Why not spend 8 cents and cap it at 15 or 20%? Yeah, I know it's a 1 in 300-year flood that's going to get hit, but when it's your client and it happens 100% of the time, you got to wipe them out. I mean, the risk some of these other guys have taken. They've really made it hard for guys like us, like Jay, all these good guys out here that really do a good job managing risk. It's made it really hard for us, for people that don't manage risk.
You guys sent me a paper also that I wanted to talk about. It showed a strategy of writing out of the money put spreads instead of in the money put spreads, like right now the funds that are out there write an in the money put, basically a 60 delta put, slightly in the money. But you guys showed me a paper that's really interesting. I want to read again. And you have varying, I guess, based on the volatility regime or probably where the VIX is, you vary how far out of the money you sell the put. Would you care to talk about that a little bit?
Yeah, sure. So we're looking at there's two schools of thought, or there's probably more, but there's two main schools of thought. One is write as aggressive as you can and bring in a lot of money. That's one strategy. The other strategy is have a premium target, an annual premium target you want. And this is done at the private bank level. JP Morgan does it. Sure. Goldman Sachs has a program they do. So basically you have a client and you can't, in your marketing, you can't, target returns, but from a risk perspective, the return of selling option is directly correlated to your risk. So it is a conversation you have to have. So for example, if I told you I'm targeting 20%, you would know that that's probably pretty risky. Then it's pretty risky relative to a strategy that's targeting 5%. Yeah. So we try to target a strategy that we're going to bring in annualized 5 to 7% of risk premia and make that income, right? I mean, everybody says income. Technically it's risk premia until it expires, and then you could, looking back, you call it income, but it's risk premium. So in that program, we're targeting 5 to 7% premium. So what that it's a beautiful thing, because what that means is in a low vol regime, think VIX 12, 13. Sure. I can sell 30-day put spread, 1.5% out of the money, let's just say, starting at 1.5, and the distance can vary. But I sell that 1.5% of the money. And my probability of getting hit would be, X, a small number.
Sure.
Well, let's say VIX spikes. The VIX spikes. Now you're thinking of a vol regime, where the VIX is at 20, 25. Okay, maybe 30. All right. So spot SPX moving all over the place, and you say, well, wait a minute. If I write at 1.5%, I'm going to bring in a ton of premium. Now instead of my 5 to 7 target. Now, so the dog's even excited. I love this, right? This is good stuff, right? Dogs get excited.
Oh, hell yeah.
So now if I write 1.5% out of the money, the probability I get hit goes way up.
Yeah.
But I'll bring in 15%, let's say, annualized premium.
Sure.
What we say is, well, wait a minute. I only need to bring in 5 to 7%.
Yeah.
Okay. So now there have been cases where I've been able to write 10% out of the money to hit my 5 to 7% target.
Yeah.
The loss of capital probability is very low.
Very low. Yes.
Much lower than if I wrote it, 1.5% or 2% out. So we write with a target premium in mind, and that helps us write our options what our models show us to be a safe distance from where at the money is, or what we determine is the forward rate for SPX in 30 days.
Well, I love that paper. It was a good paper. I love all the stuff you guys sent me. I got several things. We're here at about the hour. I feel bad I didn't have more questions for Tim. I have a lot of questions in my brain that deal with strategies and stuff, but I wanted to kind of stay on XVOL as much as possible today. But Tim, I might, if it's all right, I might shoot you an email if I have follow-up questions. I know I'm going to think of things, but anyway, I'm really fascinated by what you do, the index business. For some reason, I really think that's fascinating. The index construction business.
Oh, it's a whole new frontier. I mean, for years, investors have accepted that, we can only use an MSCI World or an S&P 500 or whatever.
Yeah.
We never really consider the construction mechanism. And the reality is that you can put into an index format almost any kind of strategy, a smart strategy, smart beta, smart factor, whatever. Yeah. And so it creates this new tax efficient delivery mechanism. I've got a strategy I'll send you that you're probably not going to believe the numbers on it, but it's been running live for quite a while now. And it's just a rules-based system using S&P 100 stocks, but it's strategy driven as opposed to just saying, we're going to do this market cap, which market cap, if you think about it, is a strategy itself. You're just saying, I'm going to go with size.
It's momentum, right? I mean, basically, yeah.
Well, it's size. It's saying I'm going to take size as my factor. Well, it may work, it may not. So I'd rather be in control of what I'm delivering as opposed to just taking a chance.
My point was, though, as the size grows, those are the ones that have gathered more assets. So I'm calling that momentum. I don't know if it's officially momentum, but it's also, don't they call it survivor bias or whatever? How when you look at indexes, you have to be careful about that. However, but as an index investor, the survivor bias helps you or whatever. It'll help you, but you don't have to worry about it. They reconstruct the index for you. If a company sucks, they drop it out of the index. Mm-hmm. Company gets better, they put it in the. I just love indexing, and I love the random walk down Wall Street theory and the efficient market hypothesis. But so we could talk about that forever as well. But I appreciate both of you guys being here. Right, I really enjoyed that conversation. I thought it was nice of Tim and Rob to come on the show. I was being serious when I want to speak with each of them again separately. I wanted to get a lot more into the option stuff, and I'm sorry if I went a little too far into the option stuff this time. But anyway, I hope you guys like this. I think I like these funds. Kind of an all-in-one type thing. It's a fund where you can, they'll produce some income for you. They'll also have a, tail hedge, and they're also, trying to actually generate some alpha with their stock selection strategy. And, you heard them, they're using dividend achievers as their universe to start with. So, and then overlaying momentum on top of that. This has all the stuff that I love, because I like when you're using two disciplines or two strategies together to confirm. And that's what the momentum on top of the dividend achiever universe does. Because just because something's a dividend achiever, occasionally there's dividend traps, and you heard him talk about that. Anyway, when you put a momentum overlay on top of that, that gets rid of that just systematically gets rid of the underachievers, the ones that, because it's great. Factors are great, but the ultimate factor that everyone wants to see is the stock price to appreciate. So I think these guys do a great job. We're going to keep an eye on this fund. It's criminal that it had 7 the other day since I started talking about it. And now it has, I think I'm a jinx on it. Anyway, I was checking. XVOL, where is it? It's right up here. And now it has 6.58. So, it's a good fund. Both, not only that one, Z hedge is a good fund too. And also there's not enough AUM for Z hedge, or not as much as you would expect. Next time I have Jay on, I'm going to ask him about Z hedge now that I'm into these types of funds more. All right, guys. Well, I appreciate you for being here. I hope you all liked it. Have a good day. Leave me a comment. All right. See you later.